Liz, let's talk about the stock market reaction, the reaction in equities. You're now talking about the Dow down by about 110 points. That's an improvement from where we were before the numbers came out. Market seems to like what we have seen with some of these things. This is pretty much a good number. It's not too hot, not too cold. Goldilocks maybe right on the head.
Yeah, I mean, I would have preferred to see a slight miss, but you're right. It's not too hot. And I think it does give the market some flexibility to try to decide, okay, maybe we're not going into a terrible growth scare that we thought we were. However, I would caution people that the labor market is one of the last things to respond. So I still think that we're going to see a leveling off here. Maybe we haven't seen it yet in May, but I still think we're going to see a leveling off and a little bit of softening through the rest of the year.
Let's bring in Steve Leisman. Steve, you have had a moment to kind of take a look through some of these numbers, get the good, the bad, and the ugly. For the most part, we haven't seen anything that looks awful. The wage increases did go up a little bit, especially on an annualized basis. But this is nothing that was a huge surprise, I would think.
No, and I get this stage for a Goldilocks, what it would look like. And this is pretty close. We've, 390,000 people employed, but we brought in 130,000 people into the workforce. That's the number we're hoping for, at least those numbers being more or less in line, so to speak. Good distribution, it looks like to me. Factory jobs up 18,000, construction jobs. And then, of course, you had the service sector really power ahead with job growth. So that, look, we don't have attenuation in wages yet. It still seems like there's workers out there for people to hire. So feel pretty good about this. I don't think this breaks the inflation. Either way, it doesn't make things worse. It doesn't make things better. This way, bringing people in to those we're putting to work, at least it won't get worse.
Hey, Neela, you said that this was a supply issue, that it's not that we don't have jobs that need to be filled, it's that we don't have enough workers to fill them. Maybe the good news here is the participation rate ticking up a little higher by 1/10 of a percentage point. That's good news.
Yeah, it is good news to see it tick up, but let's not get too comfortable with that tick up because it's ticked around for the last several months, up and down, still remaining about a percentage point lower than it was before the pandemic. So it is definitely a place to watch. I'm encouraged by the solid number. I think it's a good thing. I think it's unequivocally good to see more people working in this economy. I don't read that as a negative. Especially when you look at average hourly earnings that were still contained. They didn't explode despite the solid hiring. So the only wish list for me right now is that labor force participation rate, that it continues to improve, that we get more people in this economy and on a percentage basis back into the labor market. That's going to drive growth going forward. It's going to actually control wages as well because there's more people, less competition for workers, and wages hopefully can stay within a range that doesn't drive up inflation any further.
Sri, there's so many numbers when you dig in that stuck out to me. I mean, to Neela's point, 1.8 million people said they were unable to work last month because their employer closed or lost business due to the pandemic. 1.8 million small business shutting down, unable to work. This is also incredible, and it goes to the inflation story, Shri. I think you're in California. I don't know where you are, but I know you live in L.A., $7 gas. What percentage, Becky, of people remote worked in May? We talk about work from home constantly, right?
I would say 18%.
7.4.
That's wow.
7 point, meaning people are on the road. Shri, it just goes to the energy inflation story to me, that people are coming back to the office in a big way. That's going to jack up energy prices.
Brian, what you said takes me to a very, very important point, which is the Fed keeps talking about personal consumption expenditure inflation number, which is much lower. To me, that makes no sense. Your Social Security benefit is adjusted by the CPI. Various other adjustments are done by the Consumer Price Index, which is still at a much higher level. And the reason is Consumer Price Index has, in the headline, has fuel and it has food included in it. The Fed doesn't want to include it so they can show a much lower inflation rate. You and I, Brian, we don't live by the core index. We live by the overall consumer price index. It's going to stay high. And on the interest rate, I would go with what Rick said a couple of minutes ago. When you go to the next 2 or 3 rate increases through September, you're still finding out that after another 150 basis point increase through September, we are still below the neutral rate of interest. That's when the market will take fright. I don't have the comfort that Neela has. I think the unemployment rate has to go up. Wage increases have to come down well below the 5% level before inflation can be controlled. That's not politically an acceptable scenario.
So what's the outcome, Sri?
The outcome of that is a lot more pressure on equities, maybe delayed, to the extent they don't want to have it, Becky, before the November elections, postpone it to 2023. And this is going to be a long, drawn-out saga. So don't take comfort from today's jobs numbers. This is nowhere like a Goldilocks. If you look a year ahead, it is going to be much worse.